Blog Talk Radio.
Warning. The following program may cause cognitive seizure, sudden and violent recognition of the truth in our capital markets, and change in voter affiliation. All opinions expressed on this program are the sole viewpoint of Ticker Guy and not necessarily those of Blog Talk Radio. Be aware that Ticker Guy is not a registered investment advisor and that investing or trading in the capital markets inherently carries the risk of loss. Some strategies may involve the risk of loss of more than the amount invested. Before making any investment or trade, listeners are strongly cautioned to consult with a licensed investment advisor of one's own choosing.
Pretty much every single bank is plunging. Another ugly day for stocks.
There's no hyperinflation coming.
You remember what I told you?
There's a deflationary depression coming.
The rumor became the reality.
It's a 1930s print that.
Protect your wealth because it is under attack right now.
And that's why you're seeing pain across the street now.
This is the depths of hell to which we descended.
America has become a second-rate power.
Betting on 6,000 nuclear weapons and nothing else.
This is an out. I don't give a damn what you think you are entitled to. The fear factors are jumping up here. I wouldn't even be in this situation if it wasn't for you.
The stock trading is bad, it's furious.
You're out of your mind. It's going wrong.
Well, good morning, ladies and gentlemen. We have a very special show here. It's only half an hour instead of our usual hour, but we have Reggie Middleton with us from Boom Bust Blog. Untie my tongue there. Boom Bust Blog. And Reggie, of course, has also been seen in a number of other venues. You were on Bloomberg a couple of days ago, weren't you?
Yes. Actually, I was on CNBC Monday, day before yesterday, and I was on Bloomberg the week before that, and a month or two before that.
Yeah. Well, when I see things on CNBS, I have this almost uncontrollable urge to shoot my television. So I try not to watch it any more than is absolutely necessary. I want to throw a softball out here at you and just let you take a big swing at it here. I got a story on the wire this morning that I just wrote up just a few minutes before we came on the air here, and it's a quote from Richard Bowen, who apparently is a former chief underwriter for Citigroup's consumer lending group. Said that he said that he warned his superiors in 2006 that 60% of the mortgages that they were originating and selling were defective. He also said that by 2007, it was more than 80% of production. Now, we keep hearing that these putbacks aren't going to go anywhere, that the fraud investigations aren't going to go anywhere, and that foreclosure gate is just this minor little paperwork issue, as if perjury is always just a minor little paperwork issue. I have maintained since 2007, when I started the market ticker, that securitization with the true risks embedded into the loan structures was unmarketable. That if you took all of the tranches and put them together and you actually tried to sell them, you would not be able to do so without some sort of cheating, because the math just simply didn't work. There wasn't any reason for anyone to buy them with the actual risk of these loans exposed to them. So somewhere somebody had to be lying. And I didn't know exactly where the lies were, but I knew mathematically that had to be the case. And now we're finding out where the lies were.
Sure, you're
and
just
so
scraping the surface of the lie.
Reggie, what I'm having a problem with here is how do we get this situation where this stuff has been talked about now to one degree or another for what this hearing on the FCIC was in either late August or the first part of September, where these statements were made. The S&P 500 is up over 150 handles, and the Dow's up well over 1,000 points since this stuff showed up in the public's consciousness. And yet everybody runs around and says, oh, it's no big deal, it's no big deal. 80% of these loans that were produced during 2007 that went across this guy's desk were bogus?
Well, they're like you. I've been, crowing that the banks are bankrupt economically for quite some time. Let's take the best case scenario of that Citibank story. Let's say the manager was exaggerating, and 50% of the loans were defective, and you had roughly a 60% recovery rate. That would be somewhere around, don't quote my math, 30% that the banks would get back. Most people don't realize that the banks are going to be forced to buy back these loans. So they're probably going to have to go out to the capital markets, or they're going to use that big cash flow that they've been saving from the government and taxpayer to go back and buy the loans. But they're going to take an instantaneous loss. If they're buying the loans back at face value, the loans aren't worth face value. If they were, then the investors wouldn't be forcing the buyback. So you're talking 40% of the capital obliterated instantaneously. Let's assume the banks did have to go to the capital markets. Would you lend Citibank $100 to know that you're guaranteed to lose $40 immediately as soon as they get it?
Well, no, and see, this is the thing that I've always been talking about since when I first started the ticker, was I said that my analysis just on the back of the envelope, and with a precision of plus or minus a couple $100 billion, which was close enough for the purposes that we were at that point, was that we were looking at somewhere around $3 trillion in losses in residential securitization and residential lending, and that was back in 2007. We've taken about $1 trillion of that through the vaporization in the subprime and Alt-A space thus far, but that's all. And so, and then it just suddenly stopped, and all of a sudden the provisions start coming down and everything. I thought, oh, wait a minute, where's the other $2 trillion? And then I see this, and production in 2007 was what, $1 trillion and change? So if, you take a best case scenario, what are we talking about here? Just 2007 production alone, $250 billion in losses instantaneously?
That's just about
and that's just 1 year.
Entire system.
Well, yeah, but that's just 1 year. Then you have to, 06, there was a bunch of trash in 06 as well. We all know that. And there was probably, and up until the point that Lehman blew up, there was probably plenty of trash going on in the early part of 08.
04 and 05 as well, and 03. I was actually in the real estate business in New York, so I followed it closely. I looked at what brokers tried to push. Basically, most of the banks that relied upon third parties for underwriting, brokers, have significant trash, guaranteed over 50%, guaranteed, because the brokers worked on the OPM, the people's money factor. They simply were churning loans, and the banks were working on the same premise as well, with the understanding that they package the loans and sell them off. The problem didn't rear its ugly head until they couldn't sell the loans anymore. All of a sudden, these were now permanent investments that were worth, then the banks knew they were worth roughly 45 cents on the dollar. But again, it goes back to my original premise. Most people the media is now focusing on whether the banks will have to buy the loans back in litigation. That, assuming they could get the capital to buy them back, is not the issue. You're talking at least a 40% wipeout upon the buyback. They're buying back at face value. They'll immediately get marked down. And there's no extend and pretend here. You're talking instantaneous market real price recognition, because the investors are putting the loans back. So the bank can't say, oh, well, PIMCO forced me to buy $10 billion of these whole loans, and I'm going to market it $10 billion on my balance sheet because that's what it's worth. It's not going to fly. Well, then again, you never know, because it flew in 09.
Security where you there's no over-collateralization or any other games you can play with it. It's just, it is what it is. So, I mean, I guess I'm just, I'm stunned at the market's lack of reaction to this. Just a quick back of the envelope view says that none of these banks have enough equity to be able to actually take this and survive, and some of them, one of the institutions I've been yelling about now since the whole 08 thing really got going, as well as Fargo, and the reason is that Wachovia, with their pick-a-pay option arm thing, towards the end of the bubble, they were selling credit default swaps on their own deals and keeping them off balance sheet. And it's kind of like, it's kind of like writing fire insurance on your own house.
Right, we picked that up as well. Yeah, we picked that up.
Yeah, and the problem with that is that Wells now has that liability, and it's still off balance sheet, and all you've got is a footnote in the quarterly reports that says that we have this off-balance sheet box of stuff. It's currently well north of $1 trillion. What are the embedded losses in that thing? I have no idea. I mean, they've got $300 billion in debt that could potentially be crammed down, which is I don't know if even that's enough. I mean,
and the travesty is how emboldened bank management is in bringing down provisions. Think about it. If you ran the company and it was your own money, not shareholders, or you were the 100% shareholder, would you even consider reducing provisions? If you look at the provisions simply for rep and warranties, we're talking, 1.5% of total loan production, origination. Now, in the best case scenario imaginable, they're going to get more than 1 or 2 or 3% put back to them. Best case scenario. But it's amazing because I would assume that bank stocks would tank with anybody who can add. And it's coming. I'm pretty sure it's coming. But it makes it very difficult for the average investor to actually take advantage of it outside of staying out of bank stocks in general, which I think they will do. If the banks have to go back to the market for another equity offering, it'll be very interesting to see how it does and how it gets bought and who buys it.
Well, yeah, I mean, my obvious question is who in the devil would buy a big secondary in a situation like this when you have, I mean, this is, I guess what this goes to is when you start to see accounting irregularities of any sort, the first question I ask as an investor and as a trader is, okay, what else didn't you tell me?
well, Carl, let me answer your first question. You're going to buy it. Of course, you pay taxes, and it gets funneled to the reserve, and they're going to take it out.
But well, now, wait a minute.
You know how many bank stocks you purchased in the last few years without you even knowing?
Well, sure, but TARP is gone now, okay? So, I mean, I'm not saying that the Fed, isn't potentially going to try to play some kind of game, because we all know what sort of game that, they're capable of. They'll do anything they think they can get away with. I don't know that you're going to be able to get anything through Congress at this point, and
right.
Especially after, after the elections.
It'd be very, very difficult above board. But Chairman Bernanke made it very clear that he had plenty of tools in his arsenal, and I doubt if he was pigeonholing himself in obvious tools with bright banners on it that say, I'm doing this. I've lost, I wouldn't say lost faith, but I'm quite sure that in some form or fashion, the Federal Reserve, the Treasury, or some arm that I'm not aware of, has been funneling money into and through the capital markets outside of what they've announced, which was purchasing MBS and Treasuries. Because the elevation in share prices was extreme, and it went against fundamentals in a very big way for a relatively long time. And it's not as if the fundamentals were opaque or difficult to calculate. It was simple, 2 + 2 = 15. And at least 1/3 of us can figure out that 2 + 2 = 15. I can't vouch for the other, 2/3, but, there's at least 33% of us that can take that and do that.